Welcome back to The Explainer. Today, we're digging into a fascinating story about how a corporate giant, a company that showed up late to the party, is now completely shaking up a market that was built from the ground up by these super nimble startups. This is the story of how GeoMart is winning the delivery wars. So, picture this. At a recent big meeting, Reliance just casually drops a bombshell. Their e-commerce platform, GeoMart, wasn't just, dipping its toes into the quick commerce game. It was already the number 2 player in all of India, a spot that companies like Instamart and Zepto had been fighting tooth and nail for. So how in the world did they do it?
And this right here, this really shows you the central mystery. You've got the market leader, Blinkit, operating in a little over 200 cities. And then GeoMart comes along and claims it's already in more than 1,000. I mean, how did a company seen as a slow-moving giant, a latecomer to the race, manage to scale up so much bigger, so much faster than the pioneers?
But you know what? The most shocking part wasn't even their market share. It was their profitability. While pretty much the entire industry was just bleeding cash, GeoMart announced it was already in the black, reporting a staggering 53% growth in transactions quarter over quarter. In the world of quick commerce, that just doesn't happen. Okay, to really truly understand why this is so remarkable, we've got to rewind the clock a bit. Let's take a quick look at how this whole quick commerce frenzy got started and why it was famous for one thing above all else: burning through mountains of cash.
So the market just absolutely exploded back in 2021. You had startups like Zepto popping up, promising what seemed impossible: your groceries at your front door in 10 minutes flat. And pretty soon, everybody jumped on the bandwagon. And of course, customers loved it. It was incredibly convenient, super fast, and thanks to massive discounts, a lot of the time it was even cheaper than walking to your local store.
Now, the way they pulled off this incredible speed is really the key. The whole model was powered by this new idea called the dark store. Basically, think of it like a mini warehouse, just stuffed with all the popular inventory, and then strategically placed right in the middle of dense neighborhoods. It's literally a shop with no shoppers, built only for delivery riders to zip in and out of.
But, and this is a huge but, this model was unbelievably expensive. You had to pay high rents on hundreds of these dark stores, fill them with millions of dollars worth of products, hire a massive fleet of riders, and then on top of all of that, you had to offer crazy discounts just to get people to download and use your app. It was a perfect recipe for losing a ton of money.
So here's the bottom line. The math was just brutal. On a typical order, let's say 100 rupees, after paying for the products themselves, the company might get to keep about 30 rupees. But just the cost of delivering that order could be 30 or even 40 rupees. And that's before you even think about rent or staff or marketing. The entire industry was basically built on burning through billions in cash from investors. Okay, so while everyone else was sprinting in this crazy, cash-burning 10-minute race, Geo was just quietly watching from the sidelines. They were playing a completely different game. Let's break down their winning strategy. It's really the classic story of the tortoise and the hare. The competition, the hares, they were laser-focused on that 10-minute speed, which meant they had to build this brand new, incredibly expensive network of dark stores from scratch. But Geo, the tortoise, they focused on slower, same-day delivery, but at a massive scale by using assets that they already own. And what was that existing asset? Well, this number is the key. Reliance Retail, which is Geo's parent company, already had this huge nationwide network of over 19,000 physical retail stores. These weren't dark stores, these were actual stores that you and I could walk into. Their playbook was just brilliant in its simplicity. When you placed an order online, it was just routed to the nearest existing Reliance retail store. On top of that, they partnered with over 2 million local neighborhood shops, or kiranas, turning them into tiny fulfillment centers. The store's own staff could often handle the final delivery, so they didn't even need a separate fleet. They only bothered building an expensive dark store once they proved an area had enough demand. It was a genius, asset-light approach. And then, in 2022, they made another killer move. They integrated GeoMart right into WhatsApp. Now think about that. This meant they could instantly tap into hundreds of millions of users, especially in smaller towns, who didn't want to or need to download yet another app. It was seamless and, for scaling up, unbelievably effective. But just using their store network was only one piece of the puzzle. The real secret to GeoMart's success? Well, it lies in a much bigger, almost unbeatable strategic advantage that Reliance has been building for decades.
Okay, now check this out, because this is where it gets really interesting. A competitor like Blinkit buys a product from a brand and makes a small profit when they sell it to you. But Reliance owns its own brands. So when they sell you one of their products, they capture the brand's profit and the retailer's profit. This gives them this massive advantage on margins, which means they can offer deeper discounts and still be more profitable.
And owning their own brands is just one piece of this huge puzzle they've built. See, Reliance isn't just a retail company. It's a telecom giant with Geo. It's a media powerhouse, and it's a growing player in financial services. All of these different businesses are designed to feed into each other and keep customers locked into their world.
So what's the ultimate goal here? The grand vision is a super app. One single place where you use your Geo internet to order groceries from GeoMart, then you buy a new TV from Reliance Digital, and hey, maybe you even get a loan from Geo Financial Services. It's a self-reinforcing loop that's incredibly difficult to compete with.
So what does this all add up to on the bottom line? When you put GeoSmart asset-light model together with all its ecosystem advantages, how does it really stack up against the competition? Well, the results are kind of wild.
Just take a look at these numbers. While Blinkit has just barely managed to claw its way to a tiny 1.3% profit margin, and Instamart is still losing a whopping 12% on its earnings, GeoMart is already cruising along with a healthy 8% margin. They aren't just bigger, their business model is fundamentally more profitable. But don't think for a second that this battle is over. Not by a long shot. You've got other giants with really deep pockets like Amazon and Flipkart, and they're now scaling up their own quick commerce games. All this intense competition probably means we're going to see some companies merge or get bought out down the road as the smaller, cash-burning startups find it harder and harder to compete.
So if there's one big lesson to take away from Geo's story, it's this. Being the first one to the party isn't always the best strategy, especially when a patient competitor can use its existing strengths, its strategic moat, to play a longer, smarter, and in the end, a much more profitable game. It's really a playbook any big established company could use to fight back against digital disruptors. And that really leaves us with a final critical question. In a world that is completely obsessed with instant gratification and 10-minute everything, has Geo proven that maybe, just maybe, that old fable is right? Does slow and steady when it's backed by immense strategic power actually win the race? It's definitely something to think about.